What is up, everybody? Logan here, coming at you guys with another video. Today I'm joined by Vance, and we're going to talk a little bit today, and he's going to talk most of the time. I'm still getting over the sinus infection from this weekend, but today we're actually going to talk about what happens to a cash-settled instrument after expiration, right? So basically SPX, XSP, we have RUT as well, NDX, any fund that is cash settled. And there's a couple of reasons why we prefer cash settled instruments, but the main reason is the fact that you can't get a spread closed out early on you, and the fact that you can't just get assigned, right, at any point, among a couple other reasons like tax advantages as well. But today I'm joined with Vance, and I really do appreciate you coming back on the channel. I'm really excited to see a little bit, because we were talking today, for any of you guys who didn't know, who maybe weren't in the Discord. We actually had a spread today that was way out of the money, then went partially in the money, and then actually finished out of the money. And you'll see your portfolio moving quite a bit. We already managed it a little bit more, but you'll see your portfolio moving up and down. So to kind of have an understanding of what it looks like and what you should expect based on where it settles, I feel like making this video kind of felt right here. So I do appreciate you coming back on, Vance, and thanks for joining me for this one.
Hey, not a problem. So yeah, when we're talking about trading options, one of the things that we prefer to do is we prefer to trade cash settled options, which are generally going to be under indexes, or if you want to, you can trade them under futures. Most of the time, futures are going to be cash settled. The main reason for this is because when you trade cash settled, your risk is perfectly well defined. And so there's kind of a lie or a misnomer with the idea that when you trade a credit spread, your risk is defined. It's not really defined in the way you think it is, because like when you're trading something, let's say SPY, or you're trading Apple or Tesla or any regular underlying that's not cash settled, there's a possibility that that trade will close, and it will close where one leg is in the money and one leg is out of the money. So your defensive position might not be in the money, which means the protection you have doesn't actually give you any protection. So it's not really defined. So now all of a sudden you're going to actually be assigned. Then you could be assigned 100 shares of something that you don't have the money to afford. Or you do, but it's a huge hit on your account. Let me give you a case example. Let's say you're doing a put credit spread on SPY. You have the 390 put credit spread. And this is the other thing about SPY, is that the options don't expire at 4 p.m. They actually expire at midnight. Now, the market moves until 8 p.m. But what that really means is that from 4 o'clock to 8 p.m., you can't close your trade, but the market can still move against you. So if all of a sudden now it's like, SPY closes at 4 p.m. and it's at 4:10, you're like, oh man, I got 10 points of the money, I'm safe. Then something stupid happens in the market, and yeah, it's not going to move 100 points overnight, which would be 10 points on SPY, but let's, for the sake of argument, say it happens. Now all of a sudden the market moves down and SPY hits 399. Well, if it's only 7 p.m., somebody can actually phone their market maker and be like, hey, that SPY trade I have that's at 400, I want to exercise. And now all of a sudden you get assigned 100 shares of SPY at $400. Now it doesn't hit your protective put at 390. So all of a sudden now you wake up to an assignment and you're flush with 400 shares of SPY at $400 a piece. That's 40 grand. Your protective put wasn't in place. And now all of a sudden if SPY now in the morning continues to drop, you're losing money on a position. So with cash settled at 4 p.m., it's locked down. Whatever it is at 4 p.m., there's a couple seconds afterward where the market does like a final settling. So the options expire at 4 p.m., but they don't settle until like 4:30 or 4:15, 4 o'clock in like 35 seconds, because the market does have like that last minute like readjustment.
Yep.
But if you're out of the money, you're good. If you're in the money, you pay. But your collateral that you've collected, you can never lose more than your with times 100 in terms of dollars. So if you have a 5 wide, the most you can lose per contract is $500 minus the credit you received, period. There's none of this tricky math. And that's what it's going to talk about here on the screen here, is in the case they're going to use in his example is if you had a short 42 of a short 24.10 call and the settlement is 24.25, that's 15 points in the money. You're minus $1,500 cash outflow. If you had the long protective put in that case at 4,200 or 24.20, my dyslexia is just killing me today.
No, why did they add like these are the numbers from where the S&P was years ago too?
I know. That's why I'm saying it backwards. It's like 42 is normal to me.
I know.
I've
Yeah,
never
I'm
been at
like,
2,400 since like 2000.
gosh, that's
So
hilarious.
if the settlement again was at 24.25 and you had the long protect at 24.20, you get $500. That means that there's a minus 1,500 outflow, a plus 500 inflow. So you're short $1,000 per contract. And again, next line here is going to talk about how if you had $3 in credit received, you got paid that up front. So you're only losing $700 lost per contract.
Yeah, and I
So
want to step in and say something really quickly. I think that's something a lot of people don't realize, is you actually keep all your credits. So like a lot of guys have messaged me and girls too are traders and have said, hey, then they're brand new to trading at this point. They're like, hey, I got $200 in credit, but my trade's at max loss now. Did I lose the 200? Like, where did that go? And I'm like, no, you're just the most you can lose is 800. And that's why I say risk to reward is so important when you're trading. And that's why hedging's so important too, because on those hedges, like if you have to pay a little bit in a debit to close something, like the hedges make up for it. Like if you made $2 in credit and then you have to close something for a $2 debit, we're at break even, right? Like you made 200 and then you gave 200 back. So you're back to break even fully from something that could have actually caused a $200 loss or so per contract, right? And some guys have 10 contracts, like that's a $2,000 swing. So I just wanted to say that before you continue on, Vance, was like, yeah, you keep all your credits, right? And no matter what happens to the play, whatever credit you received, that is all said and done, like part of the trade. So yeah, you can totally risk $700 to make 300, even though it says 1,000, right? You always keep your credits received.
yep. And generally speaking, at least with the main brokers, interactive brokers, and E-Trade and Tasty and Thinkorswim, you get paid the credit up front. So essentially what they do is they just don't take the full collateral. So if you're trading a 10 wide and you get a $3 credit, they're only actually going to take $700 in collateral from you. So that's how it works. But keep that in mind because that's important, because then if you pay the debit to close it, you're actually going to have to pay that money back. So that's just something to keep in mind. If you let it expire worthless or just let it expire in the money, you're just not going to see a difference because they've already taken the collateral out of your pocket, so to speak. So now if a spread on cash settled closes partially in the money, the math is very similar, but it's a little bit different. So using a similar type of setup, let's go with the first one here, which is it says spread out of the money first. We'll talk about that. If the spread closes out of the money, well, it closes out of the money. It means you keep your credit. Whatever you make, you make. So if you generated $300 in credit and premium, then you get to keep all $300 and you get your collateral back at the end of the day. It's as simple and as easy as that. If it's partially in the money, essentially what it is this. When you're trading cash settled, the formula is basically going to be the difference between the strikes times 100 and then subtract the position value of where it's at times 100. So I know that sounds kind of confusing. So I'm going to use this example here. If they have the 24.10, 24.20 call spread and it settles at 24.15, that's halfway between 24.10 and 24.20. So assuming that you got a $3 credit in this case, that would be your break even would actually be 24.17. So essentially, because it closes at 24.15, there's going to be a $500 cash outflow because it closed $500 in the money. So we talked about before, because you close $500 in the money, you lose $500. However, because you collected a $300 credit, you're actually only going to lose $200 in the trade.
And on Tasty, you get that assignment fee, which you
Fee.
might get on TOS too. I don't know.
TOS does not have an assignment fee that I have seen. I don't know if Interactive Brokers do.
Yeah.
I know Tasty does, and it's only on it's so just to let everybody know, it's a $5 fee per contract leg per totality of trade. So if you have one short and one call, right? So if you have like a call credit spread in this case, it would be $5 per contract. So it'd be $10 total. But if you have one contract or if you have 100 contracts, it's still $5. It's not more money per contract, so to speak.
Oh, okay.
So,
And that,
so
well,
yeah,
but in this case too, since one's out of the money and one's in the money, I think you'd only get one charge, right? In this
correct.
specific case. Cool. All right, cool. Yeah, because I'm not like the biggest Tasty trade. Like I've never taken a options trade on Tasty. Like I have a portfolio on Tasty, but I don't have an options portfolio for them. So yeah, that's really nice to know. But yeah, we were getting a lot of questions today in the Discord, and we had quite the move today in the S&P, and everybody was just asking, hey, when is the best time to de-risk? So I guess this would be the last question I ask you, Vance, is like, what really makes you determine when you take risk off versus when you keep it on, right? Based on maybe the trade's expiring that day. What are a couple things that you like to go over when you're making that decision?
Right. So I am not a fan of using stop losses personally. The
Mm-hmm.
major reason for that is because, in my opinion, stop losses have to be placed very intelligently. A lot of people just blindly place like a 3x or 4x stop loss. And what ends up happening is all it does is kill expectancy. And we've talked about this in videos before. I'm not a big fan of that. I tend to like to look at the technical analysis. I like to look at the TA. If you're in the trade room, there's a lot of times I'll be like, I'll say gems, and I do it pretty much every trading day, right? I like to say, hey, we should be going here, we should do this, we should do that. More times than not, I'm right. I was right twice today. When we went down, I said we are going to go back up. When we went up, I said we are going to go back down. So because I called a close below 4,400 today. But when everybody was worried that we were way up there. So because I tend to have a little bit better market awareness, I guess I'm a little bit better. I should say better. I'm a little bit more risky with holding stuff. But I will say this. I'm a big fan of whenever you have reached 50% profit on a spread, at that point, I tend to like to be a little bit more conservative with how I trade it. I'm a very big fan of not allowing trades that are profitable to go back into the loss category. So if you've received like $1 credit on a trade, let's say you have a 10 wide, you've taken $1 credit. If you're down to like 50 cents or 30 cents debit to close, at that point, even if you don't close it, I wouldn't let it go up past $1 again. Like at that point, I'd be like, I'm gonna cut it for break even and
Yeah.
just get out of the trade because I had a winner and I didn't take profit. If you're in a rolled trade, like some of the trades that we're in right now in the group, that's where then like I started to get a little bit more aggressive with what I'll close for. Case in point, we have a call credit spread that we've been rolling for a little while now, and from me personally, the trade went down to like 45 cents debit to close. I'm out, done. I will take that close. I will walk away from that trade. I'm happy that I closed it. And even if it's not a total profitable trade or a break-even trade, I'm out of it. I get all my collateral back, and now I can fight the trade another day, and I can make back that debit in a day or two, right? And that's just personally how I like to trade things.
Yep.
That's just me. Now, when you're talking about holding trades, like a trade you put on that day, it's a bit of a different circumstance. I'm gonna throw some numbers at you because I see that's a lot of trading, and it happens to a lot of people when it comes to gaps. There's two types of gaps, and actually, I have a video on my page where I talk about gaps, which is by the numbers on YouTube. But when you talk about trading gaps on zero DTE, there's basically you can break down gaps into two types. And the key factor is a 0.5% gap. So what you do is you look at the first two numbers of SPX and you take that number, you divide it by two. So in today's case, it was 43, you divide that by two, you have 21 and a half. If the gap is larger than a 0.5% gap, then in that case, more times than not, the gap will not fill same day. If the gap is less than a 50% gap, more times than not, the gap will fill the same day. So what ends up happening, and the reason again why I don't like taking stop losses, is because you can be right on direction, but if your timing is crap, you stop out. There's a lot of people today that took a put credit spread, which would have expired worthless, but they got caught in the gap fill because the market went up a little bit at open and then it dropped and it went all the way in, and SPX filled the gap because today's gap was only about 11 points. So it filled today's opening gap and then it recovered and it made all new higher highs in the day. So anybody that took an early put credit spread and they took that put credit spread above the gap close, so they went above where SPX was yesterday, or they went where SPX was at yesterday, most likely they stopped out because that trade went in the money. So a 2x was hit, a 3x was hit, a 4x was definitely hit. And a lot of people will trade on touch. If it touches the short strike, they all got stopped out today.
Yep.
And then the trade went right back up, made new highs in the day, went all the way up to 44.07, I want to say. Then it came back down. So mind your gaps, mind your gap fills. With big gaps, they're less likely to fill. I say that, but on last Friday, which would have been the August 18th, we had a pretty big gap. It was like a 30-point opening gap, and that gap came back and filled that day. And SPX closed the day pretty much flat. I think it actually closed down on the day after it opened up red, or opened actually after it had a green opening, a green gap. So just because it is a large gap doesn't mean it won't fill. It's just less likely to fill. So mind your gaps.
Awesome. Well, I appreciate all your time, Vance, that you took with me today and also the YouTube community. Like Vance said, you can find his channel at By the Numbers. I'll have that linked below in the title actually as well. If you guys want to come trade with us, the link to the Discord's down in the description. And if you made it this far, always leave a like and comment. And I really do appreciate all the support as always. But that's going to be everything for us in this video. You good with that, Vance? Is there anything you want to add?
Nope, I am indeed, sir.
Awesome. Well, we appreciate you guys getting it all the way down here at the end of the video, and we will see you guys in the next one.